lot of stocks which are going to be in focus, and BHEL and Titagarh Wagons is going to be one such stock set. The JV has bagged an order for 80 Vande Bharat train sets, and that's for a consideration of 120 crore rupees per train set. So that's one segment which is going to be in focus, 3% higher for BHEL, and my sense is Titagarh Wagons as well should be seeing a big bump up in trade. Also, Paris Defence, one of their arms is in now an MOU with Space Kava Exploration for space applications. So Paris Defence is the other one, 2.25% higher in the pre-open rates itself. Sula Wines own brand sales have come in higher by approximately about 15% on a year-on-year basis in the fourth quarter, and wine tourism revenue has come in higher by 18%. Sula Vineyards holding up 6.5% as we speak. There's news that Pidilite is now going to be venturing into the paint segment. This is really becoming a category which just about everyone is buying an eye for. The first rates on Pidilite haven't quite kicked in. The disappointing numbers coming in from Delta Corp, the Q4 EBITDA is down about 13%. Margins have slipped about almost 500 basis points on a year-on-year basis. Delta Corp would be a laggard today, and I think the stock is in F&O ban today, if I'm not mistaken. Also, IndusInd Bank, it actually may miss the MSCI inclusion as the FPI headroom is below the minimum requisite, that of 15%. So IndusInd as well should be seeing some red. Not Unilever, IndusInd Bank, and that started off flattish. Let's see whether there is any follow-through coming in on Kotak Bank or not, considering this was the big mover in trade yesterday with that 5% bump up that it closed the day with. Today it seems like it's going to be a much more quieter day for Kotak Bank. Venus Pipes, we just told you that Ashish Kacholia has actually picked up a 2% stake in Venus Pipes at a average price of 750 rupees per share. So that's another stock which is gapped up almost 3% in trade as we speak right now. And then there is Time Technoplast as well, which has bagged an order from IGL worth about 54 crore rupees for supply of CNG cascades. So that's another stock which is gapped up about 4% as we speak right now. By the way, Delivery is also one stock that you need to keep on your radar. Tiger Global has sold 1.6% stake at 330 rupees per share via a block deal just yesterday. The details, of course, came by last evening. So that's another stock which is going to be in focus today as well. That said, the overall market construct is looking pretty okay. Kunal, is it banks which are going to do the trick, as has been the case from March 29 lows?
Yeah, I think the banks should tend to outperform. I think in the last 1 or 2 weeks, we've seen blend of short covering, large caps participating within the banking stocks. That I think makes the mix a lot more stable than what has been earlier for the banking index. I think we look at the technical charts as well, that how the banking index has managed to break past about their 200 DMAs as well as the 50-day moving average resistances, breaking past about the 41,000 mark, which has been a big resistance for the index even on the near-term basis. So I think all of that participates adds up to the stronger participation for Bank Nifty going forward. My expectation is that now 40,850, which is just I think 150 points from the strong support of 41,000 should act as a major support, and till the time we don't break below those levels, the bias has to be bullish on the banking index.
Right, okay, just getting set for the market open. The market construct looking strong. We've made a decent 4.5% recovery from those March 29th lows. And of course, all eyes are now going to be on earnings as well. While the data points are looking strong, the market, as Kunal described, is seeing all the sunshine that it wants. Monsoon forecast as well, at least as of now from the IMD, doesn't seem to be indicating any concern for the market, considering this is a data point the markets definitely look out for. But yeah, all eyes today are going to be on TCS as we officially kickstart the earnings season with this one. The constant currency revenue growth is expected to be 0.9% versus a comparable of 2.25%. The lead revenue growth in Tier 1 IT and delays in revenue conversion due to macro slowdown. That's a commentary that we're going to be looking out for. Although Moshe Khatri believes that it's going to be better than anticipated or better than feared is the terminology that he used for IT earnings. So let's see what TCS delivers and what the stock does ahead of its numbers, given that it's been a bit of an underperformer year to date, or for that matter in the last 2 months itself. The first rates then coming in this morning, let's just see where the rates have kick-started, and it's a flat start but a comfortable one at that. 17,750 thereabouts is not any reason to complain. It's flat for the IT index, flat for banks as well, although with a bit of a positive bias. Let's see what the stocks in focus are up to, what BHEL Titagarh are up to, because they should definitely see a fair amount of excitement. IndusInd Bank, which may actually miss the MSCI inclusion. BHEL gaps up 2.5%, Titagarh Wagons up 4.5%, IndusInd Bank down 0.7%. Earnings reactions coming in from Delta Corp. Look out for what that stock as well does. We're going to be chatting with the management as well later on in the show, and that stock has fizzled out soon after opening. Sagar Cements, there is ICICI Pru, which has bought an entire 4.6% stake in of PGIM India Mutual Fund via a block in this particular company, 1.25% higher for Sagar Cement as we speak. Paras Defence, Sula Mines, Time Technoplast, and then Venus Pipes. These are all stocks in focus and should be seeing some buoyancy come by this morning. 6% is the gap up that you're seeing on Sula. Time Technoplast holding up 3.5% as we speak. And Venus Pipes is the other one that I definitely want to revisit, considering Ashish Kacholia has checked in into the stock. 3% higher for Venus Pipes and Tubes as we speak right now. What is delivery up to? Because IndusInd Bank, I can definitely see, is falling off further. So what looked like a quiet start, we're down 0.5% or so on IndusInd Bank as we speak right now. And delivery is the other one, wherein Tiger Global sold 1.6% stake via block deal yesterday. So those are a couple of stocks which are in focus. And now to the other buoyant ones, considering yesterday turned out to be a good day for Kotak Bank. There was JSW Steel as well, which held out smartly. Eicher Motors, Bajaj Auto, these were all strong stocks, as was the case with the Maruti and ICICI Bank along with Bajaj Finance. So the overall structure, Kunal, is pretty quiet for the market, but the headline number
trading right now, so would be bullish on the stock and would be suggesting to clients as well as looking to buy.
Naresh, let's get in your first trades.
So going with Tata Motors, the stock at current levels of 450-860 looks interesting. Would be looking to add more on dips to 452, 455 zones.
All right, there you have it. That's the view coming in from our chartists, looking at some of their top first trades then this morning. But let's shift gears then and put the spotlight on the markets and what the outlook is in the long term. Mirinda Karmakar in conversation then with Nikunj. Let's take it across to that conversation. Nikunj.
Hello, welcome to a brand new show of Market Makers, and we are at that juncture where everyone perhaps is asking a simple question: is the worst behind us? And is the worst behind us? Logically, if you connect the dots now, what bothered the market in the month of Jan, I'm talking about local markets, the sell-off in Adani group of stocks. The turning point, the talking point for Feb and March was US regional crisis, and today we are talking about monsoon and return of inflation, given that we are in for a challenging summer. So is the worst really behind us? And if the worst is behind us, how can one really participate in this bull market which had hit a pause button in last couple of months? Now for long-term investors like Milind Karmarkar, well, these markets, when they consolidate, they gave a great opportunity. And where is the opportunity in this market? Let's discuss all that and much more with Mr. Karmarkar. Fantastic to have you back. Thank you for joining us. I'm meeting you in person actually after COVID.
Almost three and a half years.
Yeah, it's so nice to connect with you and have you back in our office. We've hit a pause button.
Yeah.
Is this the calm before the storm, or a pause which in a sense in hindsight would be considered as a great buying time?
So my personal view is that it's a great buying opportunity. Because I always believe that human brain is wired for the short term. I try and connect history with the current situation. It's nothing to do with whether history repeats itself. I think history repeats itself because it's all about human behavior. So the way humans behaved when there were a similar situation, and I think the behavior will continue to be the same. So that is the reason why I believe that we were most of the situations which we came across between 98, 99 to 2003, we have seen a repeat of almost all those situations in the recent past.
Give me an example of what you're referring to.
Okay. So 98, 99, we had the banking crisis, banking NPAs went up to 10%. Then government had to restructure the banks. They had to put in a lot of money into the banks. We had one of the worst periods between 93 to 2003 when virtually market had not given any returns. Most of the infrastructure stocks had come out with bad results. And we had in 2001, we had 9/11. Prior to that, we had SARS. Because of that, there was, of course, it was not as bad as what we had seen recently. But still, it was pretty bad, especially in Asia and Southeast Asia. Then we had Iraq war. So there were a series of events which had impacted the markets between, say, 2000 to 2003. We had seen a similar situation now. We had bad NPAs in the banks, which now have corrected, and now we are at 1.5%, 2%. We also had, recently we had COVID, which impacted. We have a Ukraine war as of now. So I remember reading a communique from Reserve Bank of India in 31st March 2003.
Not 23, 2003.
2000, okay. That's correct. That's correct. 20 years back.
Okay.
So, which went on saying that though India is the fastest growing economy as of now in India, in the world, we still have worries about the global growth. It is likely that most of the global growth will fall below 2%. In fact, some of the countries may go into recession as well. We don't know how the impact of Iraq war will be, and it could hit India's future as well. And because of all of these things, we are extremely cautious. And then RBI had also increased interest rates at that point in time. But things changed, and then you know how the markets and the economy behaved between 2003 to 2008. Like, we had a GDP growth of, I think, 3.8% in 2003. We went up all the way to 8.5%. So that is, even oil prices went up during that time. So we are seeing a repeat of that as well.
Okay. So let's assume that the setting on the table is pretty much the same.
Correct.
Which is we are in a depressed global growth environment.
Right.
And commodity prices could go higher as growth comes back.
Yeah.
So while the setting on the table is same, I would say that the cuisine is also different.
Sorry?
The cuisine on the table is also different, right? Which is that you had China, which started leveraging and started the insatiable appetite to consume from China came between 2003 and 2008. That will not happen again. The central bank's balance sheet were at a much different level in terms of their debt levels and ability to spend.
Yeah.
Now they have to contract the balance sheet. And third, and the most important aspect, is the starting point of valuations. So the setup may look like the same, but the underlying circumstances are also different.
Okay, let me come to valuations first. So most of the infrastructure companies were showing losses that time. So their valuations were infinite, frankly. So that is as far as the infrastructure companies are concerned. As far as commodity companies were concerned, so commodity, I think we have seen the first wave of the boom already there. Okay. So there are certain things which can change 2-3 years here and there. Same thing happened with hotels also. I mean, hotels, if you see, if they are in losses, the P's can be infinite. And that is what we have seen till a couple of years back. But I remember Indian hotels going up 10 times that time as it came into profits. Yes,
so between
it did.
2003 and 2008, Indian
2003 to
hotels
2006, it
Indian
came
hotels
down
was up
again.
10 times.
Yeah. Okay. So I think it's very similar. So yes, I agree that in certain cases valuations may be high. Like that point in time, take for example, retail was not the flavor of the season that point in time. But the growth had just started. They had just entered businesses. I mean, whether it was Trent, whether it was Future Retail, most of them had just come into the market. Even Bata was at that point in time not doing so great as it was doing a few years back. Now, of course, there has been an impact. But, and of course, the per capita income, that was significantly low. So yes, the cuisine is different, but the appetite still remains same. In fact, the appetite probably is higher And because of that, I do see a repeat of 2003 to 2008 that could happen in the markets. And yeah, as far as China is concerned, I think India can replace China. What happened between 2003 to 2008 in China, maybe India will drive it this time.
So if the markets have to go the 2003 and 2008 way,
Yeah.
that time it was not TMT, but it was old economy.
Yeah.
It was power. It was
Yes.
infrastructure.
Yes.
Asset owners actually outperformed.
Yeah.
Are we in for that trade again? Because that trace is visible. NTPC, Coal India, these asset owners are coming back.
True, true.
L&T hit a new high yesterday.
Yes, it did. So industrials are likely to do very well. And there is one more similarity. When at that point in time, government spent again a lot on infrastructure. But at that point in time, it was power infrastructure. This time, they are spending on power as well as railways. So there is a possibility that industrials can do very well going forward. But again, what I have seen in the markets is that the leaders of the previous rally normally don't lead. So last time we had seen companies like Voltas going up 40, 50 times, Larsen going up 25 times, ABB going up about 40 times, Crompton Greaves going up 100 times, Thermax going up 60 times. So that may not happen. That may not happen.
So what will go 40, 50 times in this rally, in this leadership?
So
this rally?
Frankly, I have not been able to identify something which will go 40, 50 times. But I think anything to do with consumption. And the reason I'll tell you, I do believe that overall the per capita income can move from 2,500 to roughly about $5,000-6,000. And if that happens, the boom in consumption can be phenomenal. So I would still continue to identify companies in consumption which can do very well going forward. So I'm not saying that like last time market may go up 6-7 times. We have already we have doubled ourselves. So maybe a double again from here, possibility. But within that, which will go up 5-6 times as of now, I think if one wants to take a bet, it would be in consumption.
Most of the consumption stocks are trading at P multiples which are north of 50.
Absolutely.
That's the benchmark.
Absolutely.
History, since we are examining history here,
Yeah.
historically when P multiples have gone to north of 50, the future returns are always compromised.
Right.
So why do you think history this time will not play for consumer stocks?
Okay. I'll give you an example in apparel. I think overall apparel market in India is about 7 lakh crores. And there is a 8 to 9% growth in the apparel market year on year. So that means about a 60,000 crore rupees growth is there in the market. If you add the sales of all the organized retail, it still doesn't add up to 60,000. So that is the opportunity. So if the opportunity is large, these companies can grow at 35-40% year on year for next 10-15 years also. And that is the reason why the P multiples may not contract, but at the same time, those 50-60 times seems to be difficult.
So for the organized apparel market, and there are a handful of players here, do you see them growing individually at 20% for next 3 to 5 years?
Yes, definitely, definitely.
Which means if you are looking at buying some of these listed apparel stocks now, and we'll talk about the themes apart from apparel, if you're buying them even at these P multiples of 50 plus, if the earnings growth is 15 to 20%, they can still give you a stock market return of 15 to 20% in 3 to 5 years.
Definitely. Because the P's will continue to be high.
But if you're looking at a market which could be as vibrant as what we've seen between 2003 and 2008,
yes,
then isn't it time to identify real big multi-baggers? Because 20%, 30%, some would say, may not be the best return in this
fair
kind
enough.
of scenario.
That's the whole game, right? To identify multi-baggers and to hold on to it during this boom. So we are still trying to do it. And I keep my fingers crossed saying that I should be able to identify at least 1 or 2 because that's more than sufficient. So we're still trying, but it would be in consumption game. That is definite. The space will be consumption.
A thought which I'm getting from a lot of original thinkers is that for those who bought into Nestle and let's say a Colgate or a Lakme now Trent, that if you're buying into some of the consumer tech stocks now from the listed internet space, essentially you're buying some of the consumer stocks in 1990s and 2000. Let's say it's Zomato or Paytm is not consumer tech, but let's say Policy Bazaar. Would you buy into that argument?
So we are examining those because take for example, so I have to sort of balance between buying an insurance company and buying an insurance broker. Okay. So in that case, a tech company like Policy Bazaar could be interesting. Let me clarify, we have neither bought anything, neither have we sold Policy Bazaar. So we are examining these type of companies because yes, they can be interesting. So we are looking at tech as well because, as I said, anything to do with consumption. So whether it's a pharma company, whether it's a pharma distributor, whether it's a company like insurance brokers, or even a food delivery. So, but there has to be a cash flow which is not in so distant future, because if cash flow positivity is not there, then I wouldn't like to touch the company.
But Mr. Karmarkar, when you bought into Voltas,
Yes.
that time it was a loss-making company.
Absolutely.
There was no P multiple.
Yes.
So when you were investing with an upside, you were betting on the business cycle to turn.
That's
so
true.
some of the consumer companies or the fintech companies may not have cash flows today. But if I look at the commentary, let's say from a Zomato or a Policy Bazaar, now you in Paytm, they're giving you a complete path to profitability. So what looks horrible like a hole may actually be a path which will be very different as things progress.
No, I agree to you. So in these type of cases, it's very important to go through notes on accounts, to go through the balance sheet line by line and see whether they will actually be making money. Because many a times there is a lot of things which are hidden in the balance sheet. So one needs to study that. And yes, if you are confident that, I'm not saying that in the next quarter, but even if they start making positive cash flows in 1 year, 1.5 years, I will still be a bet for that.
For this decade, what to your mind could be a compounding machine? More like a linear trend. The stock may not do well this year, it may not do well next year, who knows, market conditions in the short term
I agree.
are a function of sentiment. But you're confident that this business or this company will continue to add earnings? Because ultimately when earnings they come out, markets will recognize it.
Absolutely.
Where are you confident of this linear trend in earnings, apart from consumption?
You're putting me in a... Anyway, so I think industrial should do well because...
Define industrials for us.
So, okay, industrials is anything to do in power ancillaries, in industrials is anything to do in railways, so things like that. So they should do well because government is spending a lot. The capex cycle has just started, and in both cases, whether it's railways or whether it's power, the requirement can be huge for a country like India going forward, and that is the reason why that space could be interesting.
The big difference, Mr. Karmarkar, at least I can see between 2003 and 2023, we're talking 20 years here, just a rhyming word,
Yeah.
2003 and 2023,
I know.
is the government is now decisively spending in the digital space.
Yes.
The stacks are getting created.
Correct.
The Aadhaar stack, the UPI stack.
Yeah.
That's where the government focus and the uniqueness is there. The India advantage is there. How can an equity investor participate in this entire government spending in the digital space?
So digital space, I think the biggest beneficiaries of the digital space could be fintechs.
Okay.
Though as of now, there is no fintech which is making actually money. I mean, they are not even, forget about being cash flow positive, they are not making money. But that is one space which can be interesting going forward. So we are keeping an eye on that space as well. And wherever we find an opportunity and we find that the company is close to generating positive cash flows, we could go and look at these companies in detail.
You mentioned Indian hotels, and
Yes.
again you're feeling the vibe and looking at the last quarter numbers, Indian hotels is going through a boom.
Yeah.
The management is confident that the boom is real.
Yes.
And the boom is here to stay. So for next couple of years, can a stock like Indian hotels be a direct play on consumption?
It can be. So if I look at Indian hotels or most of the hotel companies, they are already up 5 times. So they are up from 60, 70 rupees to 300, 320 rupees. So whether a repeat of that will happen, I don't know. But even now at these prices, they should be able to do well for the next couple of years at least.
Let's go back to your favorite stock, Trent. It's holding on, sir. It's holding on at a time when high P stocks are actually getting smashed.
Yes.
Nestle started underperforming. You look at Asian Paints, it's gone into time-wise and price-wise
Right,
correction. I can say the same for HUL.
Yeah.
But why is Trent outperforming? It's an expensive stock, yet it's outperforming.
Okay, so I think Trent spent a lot of time in getting their business model right. And once their business model was right, now what they are focusing on is increasing density. So like if you had five west sides across, say across Bombay, now you will have 8 or 10 west sides. But besides that, their other model, which is Zudio, has been doing very well. And the look and feel is also excellent. The price points are good. And that is the reason why Zudio is growing faster than Trent. So that is the reason why I think people are willing to bet on a company like Trent, where though the P's are extremely high, and in normal circumstances, one would not have looked at such companies, but the growth pathway is also phenomenally long. And that is the reason why probably people are looking at these companies.
You've been an early investor in Trent.
Yes.
So you have a huge comfort and a strong margin of safety.
Yes.
But for someone who's really watching the show and wants to really understand and implement,
Yeah.
is there margin of safety in a stock like Trent now also?
So it's like this, Dikunj, that while buying any stock, you need to have comfort with the business model. So as you said that I have been looking at Trent for almost 20 years. And I believe that I understand the business model. I really don't know, but that's what I believe. And that is the reason, that is the reason why my confidence comes from.
Will you buy DMart?
So DMart is also interesting because I think that whether it's a grocery business, whether it's apparels, or whether it's someone like Titan, which is jewelry business. So here again, there are no recommendations or anything like that. We're generally discussing company opportunities. And the opportunity is still very huge in these type of businesses. So I 100% agree that the valuations are very high. But if someone is saying that whether it will be a repeat of 250 times from in the next 20 years, I don't know. I don't know about that because but what happens is that for the original holder, 250 times going up 5 times is also from the base, it goes up to 1250 times. But overall, I think this particular area will outperform the market significantly. And when I say significantly, what I mean is at least by 30 to 40%. So if I see market doubling, I see consumption going up at least 2.8 times or 3 times. So that's what I'm looking at.
So are we in that kind of a market where you should expect returns from compounding rather than re-rating? Because EPS into PE is ultimately the market price.
Correct.
EPS for a lot of the good businesses is at a relative high.
Yeah.
Now you're only left with earnings growth. And
Correct.
earnings growth will not be more than 15 to 20%, 25 to 30%.
Yeah.
So are we in for a compounding return now?
So yes, we are into compounding returns, but as I said, I mean, that is the focus. But at the same time, there could be opportunities in this sector as well. Sector in the sense, this theme, which is consumption. So there could be still hidden companies here which can give you phenomenal returns. One has to take efforts and identify them. But the only issue is that you need to have extreme comfort on the management. You need to have extreme comfort on the growth path.
You bought into HDFC Life, I think, 2-3 years ago. And my
Yes.
question that time was that, look, you're buying a business which markets don't like.
Yes.
And the big picture for insurance after that has only become more competitive.
Absolutely.
Changes have happened in the tax structure as well.
Yeah.
Is life insurance in India at a disadvantage now?
So, at least history says that insurance should do well. I 100% agree with you that it has been one of the underperformers in our portfolio. But at the same time, if you meet these companies, they are very comfortable about growth. And I also agree that insurance is extremely underpenetrated in India. So the opportunity is large. But as I said, that whether to bet on insurance through an insurance broker or through an insurance company, the jury is still out. So we'll have to work on it now.
You understand the securities business. You understand the PMS business.
Yeah.
There's a huge AMC business which is now listed.
Yes.
You got UTI, you got HDFC,
Correct.
you got Birla. 3 actually. Yeah. Am I missing on anyone? 3. 3 are the ones which are listed. Those stocks are at a multi-year low.
Yeah.
While the SIP number is strong, these are businesses which are growing without raising capital.
Right.
But markets are punishing these stocks on a daily basis. Is it time to, let's say, look at AMC stock again?
So let me be frank, I have not looked at AMC stock as of now. But the reasons why I think the market is punishing them is that it is possible that what happened to broking, say after NSE came in, when the brokerage rates came down by 90%. Maybe market is looking at that. Something similar to that could happen in the AMC space, and that is the reason why it looks like that the market is negative on that. But frankly, I have not looked at these stocks.
When it comes to pharma, and before I finish the question or sentence, the automatic reply is US generic.
Yeah.
But now things are looking up within the domestic pharma very,
Yes.
very uniquely. I was looking at data that, unfortunately it may sound, but the influenza and flu numbers were strong in month of Feb and March, and the sales have gone up in double digit.
Yeah.
How should one bet on consumption and a per capita binge in the pharma space?
Okay. So long back, when I say long back, it was in the 90s that I had met Dr. Reddy himself. And I was asking him that what should I look at when I'm looking at a pharma company, in the overall environment. And he had told me that time it's per capita income. The reason being that in India, the per capita income that time was so low that people didn't have enough money for their daily needs. So he said that unless and until daily needs are taken care of, no one is willing to spend on medicine, howsoever essential it may be. Things are changing now, and I think the rise in per capita income will be a key to success in pharmaceuticals. So besides, of course, the other things. So I think pharma is, and I have always believed that pharma is a sector which depends on rising per capita income, and because of rising per capita income, higher consumption. So pharma could be interesting over a longer period of time.
So
Yes.
In fact, since we're talking about pharmaceuticals, let's really gauge what are the prospects of the sector right now. And, domestic sales, it seems, are surging amid rising COVID cases once again. Let's bring on board A. Vaidish. He joins in right now on the show, and we also have with us Aditya Khemka joining in. Chairman, hi, good morning. Great to have you both on the show. Vaidish, if I could just start off with you, domestic pharma seems to be on the uptake with, the rising flu as well as now COVID cases also, unfortunately. Do you sense that once again we could see that 2020 kind of growth spurt?
But I'm not surprised because these are all the flu season and infection season. So what you are seeing, of course, with Corona behind us, and now it looks like Corona is climbing up, but I'm not too sure that will continue. But I'm not surprised. This infection season, GI season, these are all very seasonal, and Indian pharma market will continue to have this kind of growth. It may not be as much 20 and that kind of stuff, but 12 to 14%, one should expect.
Interesting. Aditya, you must be doing all the numbers right now. Help us understand, with COVID cases now rising, do you expect sales of domestic products to actually go up?
So no, when we do our numbers for the quarter, we haven't really considered any COVID-related sales to jump up. We understand that COVID cases have been rising off late in the country and in certain specific states. But we don't feel that a majority of these cases would require significant medication. At least we don't have any indication as of now that they would. And it could be a more benign wave like Omicron was. And it may not result in significant sales for pharmaceutical companies, maybe for a little for hospitals and a little for diagnostics, if at all. But I don't think pharma companies in this wave, or at least we don't expect as of now that pharma companies in this wave would have any significant COVID-related revenues.
Mr. Vaidish, we were chatting with the Cipla management, and they told us earlier that post-COVID growth for branded medicines are actually up. And, you are seeing a bump up when it comes to Tier 4 and other cities as well, outside of the Tier 1 and Tier 2 metros. Do you see the market share of branded sales in India actually increasing?
Yeah, sure. Because you need to take into consideration the context during the Corona time. I think people were awareness for good quality brands, awareness for taking the right kind of medicines has gone up significantly. So today, if any company does a good job of building the brand, make sure the qualities are delivered to the physician, I would say the branded generic is here to stay. I fully agree with supply management what they say. I would continue to see a good growth for all the good branded generic, companies which has invested behind building the brands and building quality.
Aditya, since we have you with us, I also wanted to understand where you see the US generic cycle actually, and what is it that you're looking for when it comes to the fourth quarter numbers, because the commentary would start trickling in now.
Yeah, so we don't expect the US generic to be a great quarter this quarter. Again, last quarter in the US generic, which is third quarter, December ending quarter, there was a strong flu season in US, and Revlimid as a generic product impacted the sales of many of these pharma companies, which have a quasi-exclusive window in Revlimid in the US market, which can continue for the next 2-3 years, given that the patent actually expires in 2026. So yeah, I mean, US generic will not be incremental growth sequentially from 3Q to 4Q for most of the companies. They will actually have flat or declining quarters. And over a long term, I think structurally also, we don't see US generics being extremely profitable or a high growth area for these pharma companies, simply because in that market today, the supply is significantly higher than demand and pricing is immensely difficult. So there is a lot of pricing pressure on the products, and margins are also under pressure. And there are no significant sole exclusivities coming up in the next 1 or 2 years. So we don't feel that from here the US generic business will show any significant growth for majority of the pharma companies.
Okay, but Aditya, costs as well are coming down. Wouldn't that provide some amount of comfort to margins?
So see, you have on one end you have the US generic business where the raw material cost decline will obviously help the margins, but you would also have some pricing deflation, which is normally called pricing pressure in the US. So the margin that we'll get to see in the fourth quarter will be a net impact of how much raw material cost has declined and how much end product prices have declined. Whereas if you look at the India focused companies, there the end product prices have gone up and the raw material prices are declining. So the margin therefore will definitely look better because you have an end product price which is going up and you have a raw material cost which is coming down. Versus US generics where both will come down. So then it will be a net impact of which comes down more, the price or the raw material cost.
Right. Mr. Vaidheesh, given that COVID seems to be on the back again, given that there is the flu season in any case, which is prevalent, and, to add to that, there's so much construction happening in metros that, the AQI levels in any case are bringing about a lot of respiratory diseases as well. Given that the Indian pharma market right now is only 30% of the domestic market when it comes to anti-infectives, respiratory, or for that matter, pain medicines, do you sense that tactically perhaps Indian pharma majors are going to try and broaden this market share and, penetrate deeper when it comes to these categories?
Yeah, no, but you're right. Definitely the respiratory illnesses are on the rise. I do know that a couple of companies have invested behind respiratory, but it's definitely a good time for companies to start broaden their portfolio. And respiratory is not just only one medication. There are varied types of illness that comes along with the respiratory, either it's an asthma related or it's a allergic induced. There are childhood respiratory illness. There are a lot big areas. I do believe that this is a very big opportunity, which I'm quite sure most of the companies must be currently working on it anyway.
Okay, morning, and Mr. Vaidheesh, wanted to get in your take, given the fact that we've seen a lot of deals that have taken place in the pharma as well as healthcare space. Do you think that this deal momentum is going to continue? Are you expecting any investment in, new therapy of pharma from existing players to really move up the value chain?
Yeah, well, the deals are happening. But in my opinion, at the end of the day, the deals are primarily consolidation is to improve efficiency and scale. I do see an opportunity in the area of provider space that has happened in the hospital space. I do see something has to happen in the insurance space. As far as the pharma is concerned, in the formulation area, frankly, the deals, there are so many companies are out there. For you to consolidate and identify, deals have to happen by selectively based on the kind of brands, more a brand-based deals rather than a company-based deals. But however, there are deals can happen in the area of back-end operations of an R&D or the R&D space or in the API space. Those are the areas where India is gaining strength, getting good support from the government. So I do see interesting things happening in the pharma value chain.
Right. Aditya, just one final question. Given that in the year gone by, or for that matter, even now, some of the best pharma or other best performing pharma companies, stock specific wise or stock performance wise, have been the likes of DRL and Cipla. Wanted to understand what your pecking order is within pharma, and especially in light of the earnings coming up next.
Yeah, so actually, I would slightly point out to your question that DRL and Cipla may be the best performing stocks as long as you look at the top 10 pharma companies. If you go down the ladder further, I mean, there are many other stocks which have performed significantly better than DRL and Cipla both. And these are companies which, in my mind, the way we look at them, we call them branded generic companies because they are more focused on India, they're more focused on emerging markets, and they have the ability to increase prices in an environment where raw material costs are going up. So definitely their stocks have done better, and their stocks will continue to do better. That's how we look at it. Coming to what we feel about the coming year, I think we do feel that there will be earnings growth because for the last 3 years now, the top line growth in pharma has been about 11 to 12% CAGR, but the EBITDA growth has been only 2% CAGR, and the PAT growth is flat. So therefore, coming year, if the costs do roll back, then you would have 11-12% top line growth, but you can have potentially a 20-25% EBITDA growth and a 35-40% PAT growth. Even if these numbers do materialize, over a 3-year period, your top line CAGR would be 11-12%, EBITDA CAGR will be 10%, and PAT CAGR will be 9%.
All right, gentlemen, thank you so much for taking time out and giving us a clearer picture of the M&A activity that we've seen in the pharma space, domestic sales, and how cost pressures as well are shaping up for the pharma sector as a whole. On that note, we'll take a very short break with news that we're holding out in the green for the indices. Be right back with lots more news and corporate voices. Thanks for staying on with us. This is First Trades. Just going to identify some of the stocks that are active in today's trading session because it continues to remain a sideways move for the frontline indices and ditto with the broader markets. SIS, by the way, has spiked up a solid 9% in today's trade. You're seeing some solid momentum really on that counter within the Nifty 500. It's one of the smart movers in today's trading session. Moving on, then you've also got something like an SCI, that's a buzz in trade. EIH within the hospitality space, don't flag that one off too often, but it's a buzz. You've got something like Spark as well as Mahindra Holidays within the same hospitality sector, that's up and away in trade. And Balaji Mines, which is up about 2.8%. But it's those steel stocks that are in the spotlight. As JP Morgan says, they don't expect any further hikes in domestic market. Could this impact the company's margins? Let's find out some more details of this report. Ashesha, my colleague, joins in to give us the highlights. Ashesha?
Well, yes, steel stocks are in focus today, and this is on the back of a report that has come in from JP Morgan. First up, they've spoken about steel prices. Important to note that spot domestic HRC prices have risen nearly 10 to 15% year to date, and now JP Morgan believes that they do not see any further price hike, at least in the domestic market. They say coking coal prices have declined nearly 25% from February peak, which means that spreads have increased. They also say that spreads have now normalized to $200 per ton mark, and they expect these levels to sustain going forward. As far as coking coal prices are concerned, remember coking coal contributes about 40 to 45% of the total raw material cost, and they believe that coking coal prices could decline further here on. As far as demand is concerned, domestic demand is running strong. Export demand is also looking pretty good. Chinese Chinese steel demand will be a key factor to watch out for. Limited Chinese steel exports should keep prices stable domestically as well as in the international market. Meanwhile, they also say that they continue to see good scope for consensus earnings upgrade. Relative underperformance of Indian steel stocks is why they believe steel stocks could inch higher. They are maintaining their overweight stance on Tata Steel as well as sales. On the back of this note that has come in, all of these counters are in focus today.
And Citi has upgraded Dalmia Bharat to buy from the earlier neutral. Let's take it across to Vamakshi and understand why this upgrade.
Well, Citi has highlighted that cement prices have been muted as per their expectations, and in fact they believe that there has been a sharp fall in petcoke as well as coal prices. Now the petcoke prices have fallen from $280 per ton to $150 right now. Apart from that, the Citi has highlighted that overall they're not quite constructive as far as pricing is concerned, but definitely better cost good swing profitability for all these companies. They think that most players should benefit by around 100 to 200 rupees per ton more as compared to the fourth quarter given the fall in petcoke prices. Now as far as Dalmia Bharat is concerned specifically, definitely we're seeing some better costs and that could be positive for the company, but definitely the valuation for this counter are also looking quite inexpensive. Apart from that, they also expect that the EBITDA per ton could expand on falling cost, but the pricing is remaining quite muted. They see more clarity emerging on the core business. They've in fact hiked the FY24 and 25 EBITDA estimates largely on lower cost. So given all these factors, positive factors coming in for Dalmia Bharat, and that is the reason why Citi has upgraded its rating on Dalmia Bharat from neutral to buy. They've given a target price of 2,500 per share, which is a significant upside from the current levels of around 2,000.
All right, Vamakshi, thanks a lot for that. Market breadth is holding on. Nifty is nicely chugging along very smartly. So what is important here is that there is no evidence of any kind of a profit booking. So directionally, you are moving higher. The temptation to sell, the temptation to go short, the temptation to book profit is just not there. While the bout of short covering in terms of an pacey move is not going to be there because the weak hands have already got flushed out, you would say that the directional move by participants, folks who think that worst is behind us, they want to start reducing their cash flow, I think that activity has started. So markets are in a fine fettle, so to speak. But what is interesting is the entire dairy space. Given that this time around we are in for a strong winter, poor monsoon, milk prices have gone higher. And if milk prices do go higher, it will have a direct and indirect impact on the entire dairy supply chain. Mr. R.S. Sondi, President with the Indian Dairy Association, joins us now. Let's take a conversation forward with him. Sondi Saab, good morning. So nice to have you back.
Good morning, Nikunji. How are you? Fine, thank you.
So how's life changed for you after Amul?
Life is not changed. Still with the milk only because I'm now President India Dairy Association, which is basically a 74 years old organization representing the whole dairy industry of India, cooperative, private, equipment, veterinary, universities, everything. So better learning.
The data points are indicating that milk prices have gone higher, and that's largely because of a scarcity because of heat wave. Now heat wave happened in Feb. March was okay, April is normal. So if heat wave is not there, why are milk prices gone higher? Farmers are saying heat wave, prices have gone higher. But temperature to theek hai.
I think, Nikunji, you're right. Prices have gone higher. And what is the reason before I tell it? Are you happy or not? Or your viewers are happy or not with the increase in milk prices?
Okay. Do you see milk prices going lower if there is a good monsoon? Because IMD is now talking about a normal monsoon this year.
Yeah. No, what I'm saying is, I'm asking you a question. Are you happy with the price increase or not?
Sir, why will I be happy? As a consumer, every morning.
Yes, you are. Yeah, I'm also, my wife is also not happy. And I feel you are very happy when Sensex goes up, Nifty goes up, any of blue chip company profits go up. But we feel very unhappy when farmers' income increases. You see, when food prices increases, it is passed on to the farmer and his income increase is equal to the what increase we pay in the market. So let me tell you, let us not take it negatively. For major portion of India, it is a positive sign. Now let us look into what are the reasons. I don't think that heat wave is the reason for this price increase. Actually, if you see last 15 months, price increase of milk is around 12 to 15%. That is correct. But if you see last 3 years, 36 months, that is March 20 from COVID period to till today, increase is less than a 7% per annum. Total increase in 3 years is only 18 to 19%. It is the lowest increase in price in any food category, whether foods, vegetable, edible oil, poultry, or you take anything, or pulses, etc. Why this increase? Reason is simple. During COVID day, input costs had increased. Farmers could not increase the price because of surplus milk. So commodity prices reduced. So most of the states, dairy reduced purchase price to the farmers. So farmers were making losses, but because of the glut market conditions, price could not be increased. So they could not invest in new animals. They could not invest in feeding animals properly. And also because of COVID, the artificial insemination, whole infrastructure got delayed because of movement of people were restricted. And last year, this lumpy skin pay, which impacted some parts of India. So overall, one side input cost increased around 20%. 1.5 year price could not be increased. So what you see increase is the impact of last 3 years, not of any heat. Heat, you see, it is highly unpredictable. Earlier, people were saying that summer has come early, then suddenly winter came. Now again, say today IMD has declared that the western part of India will be a 20 to 40% low monsoon. So it is difficult to say, but I can tell you, farmers are happy, they are getting good price, and we also should be happily paid what is the genuine price being paid for the food or for the milk.
Nobody is complaining that the farm income is not going higher, rural economy is gone under stress. But I'm just trying to understand the dynamics here. Ultimately, what determines demand, what pricing is demand and supply scenario. The demand has not grown exponentially in last couple of years. It is pretty much going in and around.
No. It has gone up. Because especially after monsoon, because of Horeca opening and out of home consumption increasing, there has been tremendous increase in demand. And the reason can be that increase in price of milk or dairy products have been lower than the other protein or fat dairy alternatives, food products. So what happened is because of food is highly price elastic, demand has gone up. Horeca is consuming a lot. And growth in production has not taken place at par with the growth in demand. So there is a tight position, but I'm telling you, this is just for a few months more. As this winter comes, everything will stabilize. And till that, prices may not go up, but I also don't expect this to price going down also.
All right, Mr. Sodhi, hi there, good morning. Let's also get in some perspective from you as to what the outlook is when it comes to the summer season as well, because it clearly seems to have now descended upon us, and we will see some increased demand as well for select dairy products like ice cream, lassi, curd. What is it that you're penciling in, in light of some of the factors that you've already highlighted for these particular product categories?
Well, you are right. This summer demand is very good. If we take ice cream, last year also most of the ice cream companies had seen a volume increase of 40 to 50%. And this summer also, everybody is expecting around 15 to 20% volume growth in ice cream also, because especially the demand is coming from the tier 2, tier 3 cities. And during the COVID, people started eating more ice creams at home, in home consumption. So that is carrying on. And then marriage and other things are really opening up. So demand for ice cream is good. But more than ice cream, consumption is going more towards curd, buttermilk, lassi, or beverages these products also consume lot of milk and dairy products. So overall, I'm telling you, in all products, leave aside this, even milk consumption has gone up. I mean, all the companies have registered tremendous volume growth in this financial year's milk. And I'm again telling you, reason is price increase in milk and dairy products have been lower than the other food products. So that is where you can say demand has shifted. But now I feel because of this
link. We're just going to get back to Mr. Sodhi right now, perhaps in just a short while from now. In the meantime, let's just take stock of what the market is up to before we take it across to Kunal as well as Naresh. Yeah, I think Mr. Sodhi is back. Mr. Sodhi, if you can hear me clearly, please finish your point.
Yeah. So what I'm saying is, in last 12, 15 months, whatever increase has happened, it is okay. And it is going to impact consumption also in the long term. So most of the dairy companies are not interested to increase the price further. So they don't want the consumption will reduce because it is going to impact long-term demand of dairy and the income to the farmers. Because whatever good price we are paying to the farmers, we expect a bumper production next winter and more than that 24-25 winter. So even if dairy companies want, they want to keep the prices same, so consumption of volume growth increases.
Mr. Sodhi, always a pleasure having you on the show today. Thanks, as always, for joining in with your inputs.
Thank you.
Okay, let's move on. Let's talk about markets. By the way, we're at that 17,800 print for the Nifty futures, although absolutely flat in trade. There is better a day, or rather better traction when it comes to the broader end of the market, where you have a count of 121 names standing to the advances. Divi's, Biocon, Laurus Labs, Ambuja Cement, India Mart, they are the ones which are seeing some hefty trading activity. But what about the chart busters that our chartists are spotting out? Kunal, Nifty Bank on the cards?
Yes, Aisha, and interesting patterns from Nifty Bank on the daily charts, because the index was on the verge of a major resistance. So this is the charts for Bank Nifty, and this is the simple RSI which you've plotted for the index. Now, this is the trend line resistance where the Bank Nifty has been taking resistance from the December highs for itself when the index was almost at 44,000 levels. Look at the consistency of this trend line, that the Bank Nifty has been coming closer to the rallies have been coming closer to this particular trend line and then seeing a reversal for itself. This time around, we saw similar retest of the trend line for the Bank Nifty. But the only thing which was different this time as compared to the previous times is the previous attempts when the Bank Nifty came back towards the resistance point of this trend line, the RSI kept on making lower lows for itself. It was this time around where the RSI managed to come back and make a fresh swing high for itself, which indicates that the momentum over here could be much more stronger than the momentum which we've seen in the previous attempts of the trend line for Bank Nifty. And that's why we are preempting a breakout above the 41,000 mark. Now this acts as a major base or a support for the index. So possibly a 40,800 levels approximately, as we flagged off a couple of days back. That should now act as a major support, and we could now see a build-up of the price action as well as the RSI action for the banking index. So we can start to expect that the Bank Nifty would start a trend over here. 40,800, which is the previous swing support, that should now act as a major support for the Bank Nifty over the very near term.
All right, there you have it. That is the Nifty Bank Index being dissected in great detail by Kunal. Moving right on, Naresh, let's discuss your chart from the auto space. You've handpicked Tata Motors.
So Tata Motors, if you look at the chart, what is interesting is over the last one and a half year, during the consolidation, there were multiple times the stock went to 380 to 400 band. So it was almost 6 to 8 times where this band got tested. All sort of news got digested for the stock, and now the stock has finally started making a comeback. Back in November, December also, it tried to make a breakout move of 440, 450 levels. Again in January, finally this time around, it's a breakout move with strong volumes. And it is trying to cross the major trendline resistances of the last 1.5 years. So at this gap up point of 440 to 452, 440 should act as a support. So at a zone of 445 to 465 is an accumulate with a stop loss below 440. And if this trade plays out, it should go towards an all-time high, target price of 540 in that case.
Okay, let's talk individual stocks as well. Kunal, what's on your trader's radar?
So Reliance is the stock which I'd recommend first. Buy with a target of 2450, stop loss at 2325. And Glenmark Pharma is also making a comeback again, breaking past or coming closer to that 488 mark. So would suggest a buy with 500 as a target, stop loss at 482.
All right, Naresh, let's get in your trading picks.
So first would be a buy on Lupin. We are seeing a breakout move in a lot of uh, pharma names which have corrected quite a bit. So a short-term range breakout seen in Lupin, a stop loss at 665 and a target price of 720. Second is a buy on Balrampur Chini, a breakout done above 415 mark, target price of 460 and a stop loss at 415.
Very quick break. Then on that note, with news that 17,800 is here. Pharmaceuticals are the ones which are showing maximum buoyancy today, and financials are not. We'll take a break. Lots more lined up on the other side.
Welcome back to First Trades. Let's connect with Hardik Debar. He is the Chief Financial Officer at Delta Corp, here to talk about the quarterly earnings and the outlook ahead. Thank you so much for taking time out, Hardik. Let's talk about the operational numbers. What has really impacted the margins this time around, and what do you believe will be sustainable margins for Delta Corp down the line?
Good morning, Avan. Thanks for having us on the call. I think, the results need to be looked at a little differently. While, yes, on the face of the results, the margins look under pressure, but one has to factor in a event which was already planned, which is our dry docking of our main vessel, which is Deltin Royale, which contributes more than 60-70% of the revenue on a monthly and a quarterly and an annual basis. Now, that vessel was out of operation for about almost a month. And therefore, if you see the top line or the revenue for the quarter as compared to the previous quarter also has gotten impacted, but which is a natural phenomenon. This happens every 3 years, every 5 years at regular intervals. And therefore, I think the margin depletion, if anyone is looking at, I think should look at it in that light. And I would rather want people to look at the overall annual numbers where EBITDA margins have been resilient and strong at the both at the EBITDA level as well as the net profit level. On a like-to-like basis, considering the fact that even if I was to regularize the operation for the previous years for the full 12 months of operations, even then we have grown at about 50% on the EBITDA and over 150% on the net profit. So I think overall the business has been very resilient. And I think that is the trend that we should be looking to monitor and see going forward as well.
Hardik, hi, morning. Where is it that you see Delta Corp headed in, say, the next 5 years? And, what vision are you now foreseeing for the company? Because clearly online skill gaming revenue has grown smartly as well. You think that's a segment where you would want to make all the future investments in and grow that?
Hi, Aisha. Good morning. No, I think it's both the offline gaming as well as the online gaming, which are going to be the engines for growth as far as Delta Corp is concerned. While it is very well in the public domain, we have a large vessel which is coming. We are replacing one of our smaller vessels with a larger vessel, which obviously will address the issues around, the future capacity, future growth, and the trajectory of the business and where we see Delta Corp going. Similarly, as far as we all know, we have filed a DRHP for the online gaming business as well. The markets were a little bit uncertain in between, and therefore we weren't sure of taking the issue public. But now I think we are seeing stability. Plus, around the online gaming, there have been developments around MeitY coming out with clarifications, regulations, guidances, self-regulatory body mechanisms, which is all making the business more robust, more, clear from an investor perspective as well. And therefore, I think the IPO also should be well on its way sooner rather than later. And therefore, I think both these businesses, whether it is offline or online, both are going to be engines for growth as far as Delta is concerned.
Delta Tech IPO sooner rather than later. But, you were talking about these regulations, and just recently you have the GST rate, which is likely to be at about 28% for online games by chance. That's betting, casinos, etc. And that is the current rate, right? So there's not going to be really any incremental impact on the business. Is there any other clarity on tax structure that's required or needed according to you?
So as far as the rate is concerned for the offline business, you are absolutely right, Avan. There is no change in the terms of rate at which it is being computed today or that is being proposed. I think there was a slight ambiguity around the methodology of computation, but I think we have made a very, very strong representation to the group of ministers who were kind enough to come and visit the casinos physically and see the operations for themselves, understand the entire business. And we are very, very confident and hopeful that the outcome of the GUM is going to be in line with what the world practices and what the Indian industry, gaming industry has been practicing pre-GST era as well as in the GST era. So I think there is, while the market is waiting for a clarity from the council as and when it meets, but I think more or less we are very confident and comfortable as far as the offline gaming is concerned. And like you rightly said, online gaming, there is enough clarity being provided by the government in form of MeitY and the Information Technology Ministry, making it more and more clear and giving it a more robust industry status as far as the online is concerned. So I think we are in a very good space, Avan.
The operational numbers, given that your operating profit margins have fallen below 30% versus 37%, if I'm not mistaken, on a sequential basis. The casino gaming EBIT also has come down to 50 crore rupees versus a comparable of 61. What numbers and what visibility can you share with us for the next few quarters? And is the worst behind or not?
No, so Aisha, that's exactly what I explained at the beginning of when Avan put the question to me, is that one has to take into consideration the fact that the largest vessel that Delta operates, called Delta Royale, was out of operation for 1 month. And, if I'm doing about, say, 90 odd crores give and take in a month, and 60% of that comes, or say 65% comes from Delta Royale, and it's out for the entire month, obviously it's going to reflect on the revenue. And this being a very, very high operational leverage business, it obviously will reflect in the margins. So if you were to regularize and assume that disruption of operation because of these maintenance, I would have clocked more or less similar or better revenue than what I did in Q3, and therefore the margins would have been also similar or better. And I think it's directly proportional to the drop in revenue, given the extraordinary situation around the maintenance shutdown of sorts.
And are you worried at all with the fact that Tamil Nadu has gone ahead and said that they have, banned illegal online gaming? Is that gambling rather? Is that a worry for other states coming up with the same thing?
So, fortunately for us, unlike Rummy, where the concentration is very heavy in the southern states, poker has always been a pan-India game, more or less evenly spread across all geographic locations. So one state or the other really doesn't make too much of an impact on the top line or the bottom line. Having said that, yes, you will have a knee-jerk reaction of sorts because there are people or consumers in those states immediately get impacted. But I think then the business grows in the other geographies, and it will take its own course. And now, the worry around whether other states will take such course or not, therefore this MeitY and the self-regulatory body mechanism is going to help, wherein one of the roles that MeitY and the SRBs are going to play is go and make representations to the various states where these arbit decisions are being taken today, where, one fine day you have a Tamil Nadu which is banning it, and the other day it's an Andhra Pradesh that's banning it. So I think that is something which will be more kind of regularized with this interface in form of the self-regulatory bodies, as well as the ministry itself being responsible for kind of regulating the online gaming space. So I think better days are to come, according to me.
All right. On that note, we'll let you go. Hardik, thanks so much for taking time out and joining in. That's the word coming in from Delta Corp on their numbers. It is largely on account of one of their vessels being not operational for nearly a month, but they're talking about the IPO for Delta Tech pretty soon on the anvil. Moving right on then, let's put the focus on Divi's Labs buzzing in trade, and this is largely on the back of the fact that their March export shipments have jumped to $92 million. Let's understand a little bit more about their US sales trajectory. We've got Somit here to give us those details. Somit?
Well, if you see the pharma industry export data has been released, and what we're understanding from analysts is that for the month of March 2023, we see DV's export shipment numbers is close to around 92 million US dollars. Now, do remember this is a calculated data and not the exact data, but what analysts are estimating is that this number could be around 92 million US dollars. Now, this number is nearly 50% higher than the last 11-month average, which stood at around 55 to 60 million US dollars. Now, analysts were expecting the March numbers to be good, but still the number that has been implied is much ahead than what the street was expecting at 92 million US dollars, and this is one of the major reasons why we are seeing such kind of an up move in the share prices of DVs. Now, do remember this March phenomena is nothing new, because even in last year we had seen that in March 2022 the sales number stood at close to 81 million US dollars as against the previous 11-month average of close to 50 million US dollars. So every year the March number is good for DVs, but this time the number of 92 million is also ahead of what the street was expecting, and hence we are seeing such kind of an up move in the share prices of DVs.
We leave it at that. That's the take coming in on Divis. We're going to take a very quick break on that note. Come right back on the other side.